All right, hello, welcome everybody. Fantastic to have you with us again today for, I think this is our third investor panel event inside the mind of investors. So hopefully we're gonna be able to dig deep into the mind of an investor, think about how they think, how they assess a deal, and answer your questions that you've submitted. And I've got a short list here of some of the best questions to go through. So thanks for joining us today. And also thank you to everybody who purchased a ticket for good for today's session. We've managed, between us all, we've managed to fund a year's worth of finance and business training to a female entrepreneur in Africa, 240 days of education to children in Africa as well, and 3 years of life-saving water to people who don't have clean drinking water in Africa too. So done a lot today just from turning up. So that's really fantastic, and we really appreciate everyone's support who does buy a ticket for good for these sessions. Before I introduce our panel, I'll just highlight our next event to you. Our next event is with David B. Horn, the award-winning author. And he's going to be talking to us all about the fight for fairer funding. So if that's a passion for yours, if you hate the disparity between female funding and ethnic minorities and how little of the funding they get, then tune in for our next event where David Horn's going to take us through what needs to be done in the fight for fairer funding. So that should be a really great event that I'm really looking forward to. David's a great friend. And really good speaker, so do tune in for that one. But without further ado, we'll jump into today's session. So first of all, for those of you who don't know who I am, I'm James Church. I'm going to host today. I'm the author of the best-selling book Investable Entrepreneur, and in that book I have a section in the book called Inside the Mind of Investors, and that's kind of where this event came from, and I host these quarterly robot mascots. So I'm really looking forward today and asking your questions that you've submitted to our panel. And our panel consists of Cecilia from Talis Capital, we've got George, who's an angel investor, and we've got Myrto from Procura Ventures. So I'm going to ask them just to give a quick introduction to themselves so you know who you're speaking to and who's going to be answering your questions. So Cecilia, can we kick off with you? You give us a bit of an introduction and then we'll move on.
Of course. Yeah, Cecilia here. I'm an investor at Talis Capital. We are a London-based VC that invests globally, primarily in UK, US, and the rest of Europe, in late seed to Series B companies, with check sizes from 1 to 10 millions. We are a fairly generalist fund, having invested in companies like Darktrace, like Myrto, FinTech, Ivoca, but also Plum Guide and a few other companies in the consumer side. And the three kind of key areas of investments we look at are first, tech infrastructure, so more on the classical B2B SaaS side. The second one is around how tech is changing the way we live, so healthcare, wellness, education, living, working. And the last area of investment that we do is around the next generation. So really looking at Gen Z consumer trends, a lot of social, digital communities, and gaming infrastructure.
Amazing, lovely. Thank you, Cecilia. So George, would you mind just telling us all a little bit about your MO as an investor and what gets you ticking?
Hi, good afternoon, everyone. Or wherever you may be in the world, depending on your time zone. My name is George Mensah. I work for ACF Investors, which is, rather than me being the angel, I work for a fund that co-invests alongside angels. So essentially our fund is predicated on the mandate of co-investment alongside syndicates of angel investors. We've been going for over 10 years. We were previously known as the Angel Co-Fund, but we rebranded earlier this year. We've invested in nearly 100 companies to date over nearly 10 years. And similar to Talis, we are a generalist fund. What we look for is high growth businesses that are typically at the late seed stage, albeit we can go later and we can be earlier. But we tend to participate in companies that have established some form of commercial validation through paying customers. We tend to not lead rounds because we're a co-investment fund, but we deploy checks anywhere from 100,000 to 1 million, and we tend to participate in rounds from sort of 500,000 to 5. I'd say our true sweet spot is 750k to 2 million. In terms of our portfolio, companies that you may be familiar with, Gusto, the meal recipe delivery business, that's been one of our big successes. On the fintech side, a company called eBury, and a number of other different types of businesses. So we have quite an eclectic mix of portfolio companies, ranging from life sciences working on antibiotics to restaurant franchises in London. So we don't just invest in tech businesses, but I'd say that the vast majority of our portfolio is tech-enabled businesses. On the other side of, I guess, our thesis is that sort of co-investment. So we're looking to partner with sophisticated angel investors. We require within a syndicate there to be a lead angel. And the lead angel is someone who can provide validation to the investment opportunity through their own proprietary due diligence. And they also need to demonstrate skin in the game. So we look for someone who's investing an amount of money significant to them. That's usually upwards of £50,000 of their own money. And usually they tend to be someone that has domain expertise. So someone who's specialized in a particular sector, and they're really trying to invest not only their capital, but also pass on their knowledge to the founders and give them some of the lessons that they've experienced as well.
Fantastic, awesome, thank you, George. And Myrto, tell us all about Procura Ventures and what you get up to there.
Yeah, of course. Hi everyone, I'm Myrto. I'm an investment executive at Procura Ventures. So we're an industry agnostic fund based in Manchester, but we do invest across the UK. Our average check sizes range from £750,000 to £3 million. So we kind of come in at your kind of post-seed to Series A round. We're usually the first institutional investor in most of the companies that we invest in. We usually kind of come in post-product, most of the times post-revenue as well. And we like to have quite an active involvement in the companies that we work with. So our kind of slogan is more than money, and we're constantly trying to push kind of our definition of what that means and what we actually provide to founders. And up until recently, this mainly consisted of having a large portfolio team within the fund that's once we invest in a company, they kind of look over the growth and the support of our portfolio on a full-time basis. So that could be that's a range of ad hoc support depending on the company's needs. It ranges from working with startups on their sales strategy, opening up our network, working on marketing and branding if that's needed. We're helping companies to hire for roles in which they don't really have a lot of experience in. So kind of hiring an FD. A lot of times kind of like sit in on the interview. If as some of our team members have experience with that. And most recently, we've kind of added a new element to our more than money piece, and that's what we call the operational board. And we've basically created a team of very, very successful people in their own fields, which ranges from people that led B2B sales at Apple, for example, to people who founded and did some of the largest digital marketing companies in the UK. So we basically have like a board of very experienced people that we parachute into our companies as of when it's needed. We're only 2 years old, so we're a very new fund, and to date we have invested in about 15 companies, I think now it is. Yeah, it's across various sectors. Most of them are SaaS businesses. Some of our kind of later stage companies that some of you might have heard of are Peak AI and Sorted. Peak is an AI solution for kind of large organizations, and Sorted is in the kind of operations and supply chain space. But you know, we'll kind of look at anything similar to George's fund. We don't only look at tech, we're also kind of interested in non-tech businesses. In fact, we've recently made an investment in a company called Mixwellia that specialize in taking kind of drugs that you need prescriptions for to make them over the counter, if you know there's not a lot of side effects, so kind of opening up these new markets. So that's us, but I'm happy to, you know, answer any questions in the end if you want to know more about our fund.
Awesome, fantastic, thank you. So let's kick off. We've got our first question from Karim Badruddin, and he's kind of touching on the fact that we're coming towards the end of what hopefully is the end of a global pandemic, but we don't know, it might carry on, but hopefully the end is in sight. But it's still obviously something that's massively on people's minds, both investors and founders. So he's asking, what are the pandemic effects on the investor deck and the investor pitch, and how should he pitch to account for COVID? So essentially asking, what should he change, or should nothing change? What would your advice be to Karim? Let's go with Cecilia first.
Sure. The first question is to try and understand whether COVID had a positive, neutral, or negative effect to the company. So if it had a positive effect, something that we sometimes hear quite often is, I don't know, if I'm speaking with an edtech business and they're like, oh, we grew 5x despite COVID, but that sounds a bit wrong because COVID really helped the business. So I think there needs to be a level of awareness within yourself, and also when you're speaking with investors, on what was the role of COVID. The second thing that I would suggest is be aware that let's say you had a positive effect, that when you have growth calculations going forward, that they are fairly conservative, because of course investors are fairly aware that COVID was a bit of a situation, and whilst certain sectors like e-commerce or tech are going to grow stronger, it's probably unlikely that we see the 5x, 10x type of growth that we've seen throughout COVID. The other thing I would say, if the business has been somewhat hindered or kind of put on pause because of COVID, it's always nice to, you know, talk about what you've done in this time. So one example that we had is one of our companies was in the travel business, and that was one of the most affected sectors within COVID. But they've taken that time to really re-engineer a lot of the product side and to productize a lot of what they used to do manually before. And they've potentially kind of sped out a lot of opening different locations and really being able to kind of grow their margins a lot going forward. So when you're speaking with investors and you're like, well, you know, we're a travel business, but we haven't been able to grow a lot in sales throughout last year, but this is what we've done. I think always focus on where you, where you put your resources. And another thing that we were always kind of asking is, okay, if you've been affected negatively, what were the measures that you've taken to try and, you know, look at the burn and try and not kind of waste different money. So for me, just to kind of summarize my tip, it's always understand positive or negative effect. If it's positive, don't go out and say, oh, we've grown so much despite of COVID, because investors are aware of it, and try and be quite conservative with the growth and be aware that investors will discount your 5x, 10x of growth, and that will not be the basis. If it's negative, talk about what you've done during this time and what's the outlook of the company going forward.
That's brilliant advice. Thank you, Cecilia. That's really, really great. George, have you got anything to add to that?
Yeah, I think Cecilia covered that question off quite well. One thing I would add is, in terms of discussing sort of the growth over the last year, I think it's very important to understand whether there has been a structural shift in your sector, or whether it is just a one-off growth opportunity that you've experienced. So, for example, EdTech, we're now seeing a shift towards more remote learning. That appears to be more of a structural shift than a one-off event. Whereas some would argue that we will go back to traveling. That industry isn't dead. So this is just a one-off year. It's a freak year. It's an anomaly. So understanding the growth dynamics over the last year and how you project that into the future is really important. And I think, you know, another point that Cecilia made quite well is when you're a founder, when you're an entrepreneur, you are a capital allocator. So over this past year, whether positively or negatively, how have you deployed capital into either an acceleration of opportunities, or how have you responded to a reduction of opportunities? So how have you managed cash burn? Have you pivoted within the business's product? These are the kind of questions that I would expect an investor to want to have answers to from the team.
Yeah, that's fantastic. The way I like to try and sum this up when I'm asked this by founders is when I talk to investors like yourself, and you've kind of touched on all of them so far, is there's kind of three main areas. One is changing markets. How's the market changed positively and negatively for the business? And what steps have you taken to mitigate the risk and take advantage of opportunities? Next is changing behaviors. How has consumer behavior changed as a result? And again, the positives, the negatives, how have you mitigated the risks? How have you taken advantage of the opportunities? And then finally, the timescales of your business. Cecilia mentioned about, you know, delaying a launch of a travel tech and focusing on building the product out more, or whatever it may be. Your plan has changed. And again, what are the positive, negatives, and risks and opportunities? And if you can kind of talk about those three areas in that kind of detail, then I would have thought investors would be pretty impressed. Would you agree, Myrto? Is there anything else? Would that satisfy you as an investor if a founder came to you with that kind of approach?
Yeah, exactly. I think the main thing is that, you know, we know everyone's been impacted by COVID, right? I mean, it's kind of like hit most of the industries. It's hit our industry as well in terms of investors. So, you know, it's not a deal breaker at all if you happen to be operating in one of those industries. I think the main thing, and it kind of goes back to James, what you were just saying there, is just to kind of know the impact that COVID has had on your industry. I know this sounds silly, but you'd be amazed at how many kind of founders we've spoken to during the pandemic. And we're like, okay, well, we're industry agnostic, right? So we don't necessarily specialize on every single industry. So we expect, in particular in those first few meetings, we haven't kind of really taken the time to do our market research. You know, we'll ask questions on how the pandemic has impacted your industry, and you'd be surprised how many people don't really know. And that's just kind of a bad sign, right? Because if you're going to be investing in a company operating in a given sector, you expect the company to know the sector really well and to know how the pandemic has affected the sector, and what our industry leaders are saying about how the sector is going to progress going forward. Another thing that I wanted to add was that in the case where your industry, your company happens to really benefit from the pandemic, and as Cecilia was saying, you know, like you kind of come up with these figures of like, you know, you've grown 5x, 10x or whatever, and it could be true. In that case, the kind of questions you're going to get is, well, how are you going to be sustaining this type of growth? Is it just kind of like grown a lot because you're in the healthcare space, you're digitizing some aspects of the NHS, for example, and you've seen tremendous growth because people are literally, you know, like so stretched with resource that they'll buy anything that might help them. But how are you going to sustain that growth going forward when the pandemic dies down and stuff like that? So be ready to answer these kind of questions as well. And then, you know, in the case where your company has been affected negatively in the pandemic, I think what you can do to show a kind of to come across the kind of, you know, high quality and responsible founder, and to give confidence to investors, is to kind of talk them through how you dealt with the pandemic how you reacted to it, what are the different steps that you take to kind of protect your business from going under, and where did you make budget cuts and stuff like that, and just kind of try to use that question to your advantage to show how kind of responsible, forward thinking, and you are, and how you took initiative during a time of crisis.
Awesome, really great. I hope that helps you, Karim, and everyone else who's been listening to that, because I think it's sound advice there. So let's move on. We've got a question now from Isabella Sumner, and this is really, I've not been asked this before. We hear a lot, especially from our partners over at Seed Legals, around agile funding and the benefits of an advanced subscription agreement, or as Seed Legals would call it, a seed fast. So Isabella wants to know, are investors actually interested in agile funding, or do they prefer traditional rounds? What's your take on both the rolling close and the advanced subscription agreement that's kind of coming to the market now? Is that a good option for you? Is that something you enjoy? George, do you want to kick that one off?
Yeah, it's ASA's, advanced subscription agreements, is something we're seeing a lot more of in the market. It seems to be an evolution of the safe note from the US, which was kind of pioneered by Y Combinator a few years ago. I think the question is interesting in the sense that not every investor has the same view on whether they like ASAs or not. So ASAs were designed to be EIS, SEIS friendly. So from that perspective, I think EIS and SEIS angels are very open to doing so, using such instruments and securities. I think the reality is that eventually most investors want a priced equity event. And so what ASAs essentially do is it creates pressure from a time perspective to say, look, we need to take in this capital now, but we're unsure on what the optimal price is for both the business and investors. So we're going to push it out, 6 months. But the difficulty with that is that you have to have, comfort that in 6 months' time, you're going to be able to feel comfortable enough to price it at the backstop price. So it may be that the business actually grows ahead of expectations. And so what actually happens there is that the ASA investors actually invest at a significant discount potentially. And we're open to it. I wouldn't say it is a preference for many sort of institutional investors, but I think in times of uncertainty, as we've had over the last year, it has come to the fore as an instrument to invest through, because it's hard to understand what the optimal, what the price of a round should be, and people struggle with that quite a lot.
Yeah, so what I'm hearing is so really great the earlier stage you are, and when you're talking to kind of more friendly angels rather than who probably know you, like you, and trust you a little bit more than if you're going out to the wider market, is kind of what I'm hearing. Is that the kind of same for you, Cecilia? Is that?
Yeah, I'm a bit quite honest, we haven't come across them. No, and it's mostly because we invest a bit of a later stage. We do CLN quite often, but it's never the preferred way of our first investment in a company, because we do like a full price round, and we do like some certainty into where we're investing. We do tend to do CLNs, for example, if we invest in a Series A and the company is growing quite well, then we do a convertible loan note before they might raise a Series B, just to kind of increase our stake in the company, and to obviously get a bit of a discount. Honestly, it's not something we've come across. I do like the fact that there's some time pressure, because some safes and some CLN that I'm seeing at the moment don't even have valuation caps. So an investor is basically just putting some money in the hope they're going to get a 20% discount of a number that might be anything really. But it's from what I kind of heard and feel in the market, CLN is never, for a Series A investor plus, it's never the preferred way of entering a company. It's always like a full price round.
Cool, fantastic. And Myrto, I guess it being a fund is kind of a similar story for you, but what's your take on things like the advanced subscription agreement?
Yeah, so I think there's only been one time when we've come across it, and for that one time, I think, you know, it was kind of, it does complicate things a little bit. It's not that we're not open to it, but if, you know, if already valuing your company today is already kind of like a tricky exercise, and agreeing on a price that your company is worth today is already quite a negotiation. I think you're just complicating things a little bit by saying, you know, the company, this is what it's worth, not today, but like in whatever, 6 months time. And it just, I think it increases the complexity of valuing your company. And I think there's a lot more kind of explaining and kind of building an argument for why your company will be worth that much, and what kind of discount are you getting, and is it really a discount, and what happens if you don't hit that valuation going forward. So we've only come across it once. We weren't open to it, but you know, it did happen that the deal fell through because we actually didn't think that, compared to where the company was today, that they were going to hit that valuation 6 months down the line. So we ended up not investing.
Cool. So I guess on that brings us to kind of a question from Hugo Douglas Deanne, who's asking, what do you look for in a startup's valuation, especially one that's pre-trading, but when you're at that slightly earlier stage, and maybe you are considering advanced subscription agreements because it delays the whole valuation piece. How does a founder at those earlier stages start to agree at a valuation and start that negotiation process with an investor? Because I think the fear is that you're going to get it wildly wrong and an investor's going to laugh you out the room, I think is probably the fear, and you're going to waste that opportunity by coming in too high, or you're going to price yourself too low and end up giving away or selling too much equity too early on. So what would your advice be, Myrto, to founders in that position who are thinking about advanced subscription agreements because they find the valuation piece quite a tricky thing?
So if the question is kind of how do you value your company at like pre-revenue stage, is that more or less
question in a very much more long-winded way?
Yeah. So, yeah, I think, you know, I think the worst that you can do for your company is really kind of, because valuation will always be a negotiation. But if you kind of come in and value your company so over and above what any investor in the market will give you, you just kind of open yourself up to a situation where investors don't even want to enter into the negotiation because your expectations are so high that how are we even going to get it down to a more kind of realistic valuation? So it's a really good question, because I think that's one thing you want to avoid as well, as much as avoid kind of valuing yourself too little. I think if you're pre-revenue, the main thing that can kind of work towards your valuation is maybe the value that sits in your technology. So let's say your company ends up never making money and we've invested in your company. How much can we kind of expect to get if we sell your IP? So in that case, you know, maybe think about protecting your IP, maybe valuing your IP. I think you can use that as a leverage a little bit to increase to understand what your valuation is and to argue for it. Your team is very important, because basically, and your go-to-market strategy is very important, because if you're saying, you know, we don't really have revenue now, but here's all the people I know in the sector because I've worked in the sector for maybe a decade, or I don't know, I've made these connections, I have these relationships. This is our strategy for kind of selling into the market, and you have a really clear path to commercialization and to revenue generation, and you literally just need that cash to, you know, build that product a little bit more, or you know, that kind of situation. I think you can give confidence to investors that, you know, once you get the cash, here's how you're deploying your solution. So, I think your connections in the industry and your route to market are super, super, super important. But yeah, having said, yeah, I think that's the main thing that I would have to say on that.
Yeah, cool. George, anything to add on kind of valuing pre-revenue or very early stage revenue businesses?
Yeah, it's a good question, interesting question. And I recently did an exercise where I looked at all the factors that seem to drive valuation at the early stage. And just running through those in my mind, the first thing, what Myrto talked about is it's a negotiation. So one thing that's really important is leverage. And without leverage, you can't really get the higher valuation that you possibly would want. So ultimately, if you're engaged with 10 investors and 6 are very interested in investing, then you can obviously drive a higher valuation than if there's only one investor interested. So leverage is probably the biggest determining force as to where that valuation could land. Another factor is the team. Again,
I was just going to pick up on that. It's something that
something
that I talk about a little bit, and an investor, a shareholder in Robot Mascot, Daniel Priestley, talks about. I'm going to hopefully have him come and talk to us about his oversubscribed strategy. So hopefully that'll be an event later, which is he's used for raising funds in the past. He's on a number of third or fourth multi-million pound business, and getting more investors, more capital committed from investors than the amount you actually need to raise gives you that leverage you're talking about to say, well, we can drive up the valuation because there's demand, and the demand is outstripping supply, and then so if you can manufacture that type of situation, you end up with higher valuations in the same way as an exit happens, right? Like WhatsApp, having a battle between Microsoft and Facebook for buying, and that just threw the valuation through the roof. It can happen the same at an early stage as well if you can get enough investors excited about investing in your business. So if you want leverage, that's a great way to do it. But yeah, sorry, carry on.
Yeah, I think I might have the document where I wrote down all the points. I don't know if you'd like me to quickly share it, just because I noticed someone in the comments said there's quite a lot to take in, and it might help if they've got something visual. But it's up to you, James.
Yeah, I can give you permission to share the screen. Let me do that. There you go.
Just going to see if I can pull this up quickly.
So yeah, for those of you listening, definitely get the book oversubscribed. And although it's mainly talking about selling your product, if you apply the same strategies to selling your equity, it can work really, really well. So I highly recommend getting that book and applying those strategies to your funding round. Here we go. What have we got?
Yeah, so I just thought it'd be quickly, just so people can write this down, because I can see people taking notes. I've run through one of them there. These are kind of the valuation drivers that I identified. Traction doesn't always come in the form of revenue. It could be trials. It could be letters of intent. These are factors that can also drive valuation. And validation. So some of the companies we invest in are life sciences, therapeutics businesses, and they're not going to have revenue for several years, but they've been through clinical trials, and that is a form of validation. So can you demonstrate validation? Why the capital markets? That really is just what is the sentiment around the sector in which you operate in? Is the sentiment really strong? So for example, anything blockchain related at the moment drives a really high valuation. It's perhaps not the most sensible example, but it's just an example. IP, Myrto touched on that earlier. You can get your IP independently valued, and that can be a benchmark for valuation. Size of the market opportunity. Some investors are willing to pay a premium for really, really large total addressable markets or businesses that are operating in such. and then how much you're raising versus dilution. So dilution is probably one of the biggest factors in valuation. So how much of the business are you giving away versus versus how much the business is worth in total. So valuation and dilution work hand in hand, and that's something you need to think about. If you give away too much of the business, you can potentially lose control, and you could potentially be pushed out as a founder. But if you give away too little of the business, investors can quickly become disinterested. So these are things you need to think about. And then size of the team, finally, you need to think about, again, with dilution in mind, there needs to be enough incentive for every founder to grow the business. So that's another thing you need to think about. I'll stop sharing from there because it can be quite long-winded if I carry on.
No, that's a really, really great summary, and I think probably very useful to everyone on this call. So thank you for running us through that, George. It's really, really insightful. Let's move on now to another question. We've got Laura Van Zyl has asked what your three most important aspects of a startup business plan that you're looking at when you're making an investment decision. So if you were to say, like, there was three key things that are the key kind of drivers of your decision making, what would they be? And Cecilia, do you want to kick off with that one?
Yes, it's quite a hard question because it really depends on the type of company and the sector. And actually, I'd say that the first thing that I look at is whether I believe that company fits one of our specific theses on that sector, or whether it's something completely different that I might look at from an opportunistic point of view, but I'm not fully bought into, the vision of the company. But when it's going, drilling into the company, for me, it's quite important whether the company has the potential to go viral and kind of benefit from network effects, and whether we're already seeing those here, because network effects are an accelerator of businesses. The second thing really depends here whether it's a B2B or a B2C side. But when I'm looking at a B2B company, I try and understand what is how is the sales team structured, and whether they actually have like a machine to really increase the flywheel. Whether in the B2C side, I try and understand quickly the split between organic and paid acquisition. And the last thing I look at, there's plenty of things that we look at, but another thing is really on the retention side, because what you want is to spend some money and some effort in acquiring customers, but then you want those customers to stay and enjoy the product. And there's nothing that explains to me more the fact that you've reached product market fit rather than retention rates or net revenue retention, whether depending if you're B2B or B2C. So to me, overall, those are like the key things that I look at. And I know there's another question afterwards in the key numbers and concepts, so I can distill more into that.
Yeah, awesome, fantastic. And Myrto, what are the three things in the top of your list and that you like to look at?
Yeah, sure. So a huge one, and you'll hear this all the time, is the team. So how experienced they are, how passionate they are, how well networked they are in the sector, what kind of people they've been able to bring into the business, because that's takes a lot of skill to be able to get really high caliber people working for you. And I know I probably shouldn't say this, but there's one investment that we made that I'm not going to say which one it is, but it's literally, we didn't even fully understand the product, but the founder was so good. And we just know that whatever he does, it's going to work, and he knows the market very well. And it doesn't matter that we don't understand it as well. We know it's going to be a win. And it's a silly thing to say, but it just, like, being an incredible founder just does so much for you, or building an incredible team that you can put in front of investors will do so much for you. A second thing would be kind of like seeing that there's market pull. So other than, okay, there's a really big market for this, to what extent are people really dying to have your product? And it's incredible, you know, and kind of going back to this investment that we made when we did kind of make a few reference calls of people that they said to us were in their pipeline, we could really sense that, you know, the market really wants it. Doesn't matter what it was. We barely even knew what it was, but the market really, really wanted it. So if you can demonstrate and, you know, build a case for why there's pull for what you're building, I think that kind of can do so much for you over and above kind of demonstrating that there's a large market. And then a good business model, I think, is the third one. But this, you know, there's so many different ways in which that can manifest itself. I would say if your pricing is relatively low per unit of your product, I would say make sure that you really demonstrate how your users using your product and paying for it, and how you're going to reach these really large numbers to be able to create a very profitable business, because that's what it's about. At the end of the day, it's about investing in very profitable businesses. So, you know, if you're making kind of 1K, 2K per month, great if you're at the early stages, but especially if your pricing per unit of product is very low, you really need to demonstrate how you're going to reach extremely large numbers, and there's a market, a big enough market for it anyway. And, you know, similarly, if you're selling something that costs maybe hundreds of thousands of pounds per month, that can be quite attractive. But again, demonstrate it's a harder sell. Obviously, demonstrate how you're going to be able to sell this, what's the value in it for the customer, and how you're going to make sure they're not going to kind of purchase it for a year and then drop it. So how would you make it sticky? I would say these are three of the things that you know, if you build a really solid case for, we'd be really excited.
Yeah, awesome. Well, I love the fact that you brought up that you invested in a founder and not their product, because that's essentially my whole the whole thing around the concept of my book being presenting yourself as an investable entrepreneur. And actually, I use the analogy Andrew's put in the comments, the Elon Musk effect. And I kind of use that as an example. He could just have an idea tomorrow and people would back it without question, because they know everything he touches is going to succeed, because he's just proven it time and time again. And that has such a massive impact.
Exactly. Like, do you know how he made monkeys play the ping pong game using their brains? No. Are you going to? Yes.
Yeah,
it's kind of that same exact
exactly.
concept.
And founders spend so much time focused on the concept and the idea. And in the last panel event we did, one of the angel investors said that the idea, the product is about 20% of the decision making. So make sure that's only about 20% of your pitch. You know, it's all about the other things you mentioned. How are you going to implement the strategy? How are you going to grow? How are you going to get that scale to get that return? So that's really awesome. Thank you. So George, have you got anything to add? Are there three things that, or anything else that you would look at that hasn't been mentioned already?
I don't personally think you can narrow it down to three things. But what I would say is that just that point there is really important about, I guess people tend to split, you know, early stage investing into three buckets: team, products, market. And the team aspect is so important. So you talked about Elon Musk there. You know, you could take the example of Jack Dorsey as well, what he's done with Twitter and Square. Certain people, if he came up with a new business tomorrow, would just deploy capital into it without even really understanding the product. And yeah, I guess it goes back to that old adage that, you know, ideas are cheap, everything's about execution. And what you want to do is be able to convince an investor that you can execute, whether it's on the business plan that you're selling today, or whether you have to pivot later. The ability to problem solve, because that's what a good founder is, that's what a good entrepreneur is. They are a problem solver, and that's what you look for. And I think an interesting thing as well that I think is really important, and I think more people are paying attention to, is, are you someone that the best talent are actually going to want to come and work with and for? because it's not easy in an early stage business. A lot of the value as a really talented operator is in the future. It's not about the salary today, it's about what you can build for the future. So people are having to concede a lot of value early doors. And if you're not particularly the most attractive person to work for, it can actually destroy a lot of value of the business. So I think that's one thing that I think increasingly is becoming more important to investors. Is this an individual that the best talent would want to work for?
Yeah, that's brilliant. That's really, I call that a highly resourceful entrepreneur. You're looking for someone who can get people to buy into their vision, whether that's whether that's potential investors or getting great talent to work for you below market rate in return for equity, because those types of entrepreneurs not only get great talent and make things happen, but they're also going to attract great commercial partnerships or joint ventures that are going to open them up to new markets and allow them to establish themselves and accelerate much quicker. So that all comes down to that pitch at the end of the day. You kind of get that sense, don't you, from the way they present themselves and the way they pitch their business almost instantly. Is they're going to are they that type of founder, and you kind of make a decision very quickly.
One example I would, perhaps a more localized example of that kind of founder is Alex Chesterman. I heard him speak, how long ago was it? Maybe 5 years ago, in a previous job that I was in. And, you know, at the time he was the CEO of Zoopla, and I left that meeting wanting to invest in Zoopla. And if you look at his success, he's done Love Films, he's now done Kazoo, which just listed in the US. You know, there's several people that would just invest in him just on an idea with no traction whatsoever, and he's in that bucket, that Elon Musk bucket as well.
Absolutely. So it's all about trying to, you know, when you haven't got that resume, it's then about presenting that you have the ability to make this happen, and presenting yourself in the right way, and leveraging that past experience. So you may not have had a business before, but what have you done in corporate life that proves that you can make stuff happen and achieve results? I think fantastic, awesome. Let's move on then. So the sort of follow-up question to that really is just digging into the kind of the key numbers and kind of metrics that you might be looking for. Probably for later stage businesses, let's sort of mix it up a little bit. But so this is from Gina Cardenas, but the key numbers, the key concept that you need to know to analyze whether it's a good investment or not. So what are your kind of favorite metrics, if you have them? I don't know if you have favorite metrics, but what are your go-to kind of metrics that you go to find out whether the company's performing or whether their financial model stacks up? Because you can use those metrics obviously to assess their ability to put together a financial model that's credible. So what are the ones you look for? And let's come back to George. Let's kick off with you.
Yeah, I think in terms of early stage, even later stage companies, I think what's interesting about financial model is there's only one guarantee you're going to get with a financial model, is that it's not going to be 100% bang on. So I think what it tells you a lot about is how the team is thinking about growth, how they're thinking about the journey, and how they're thinking, what are the assumptions that they're building in their mind about the business. So it's more a teachable moment about their thinking rather than the actual numbers on the spreadsheet. In terms of metrics that you'd focus on, I mean, B2C side, I think you focus a lot on, I guess, sort of customer acquisition, and how resourceful, how economic are they with marketing spend. So, you know, loads of businesses, it's very easy now to get, through revenue-based financing to get money to deploy into capital, and it's easy to grow the top line using advertising spend. But how economic can you be with that whilst maintaining or perhaps even growing margins? And how are you deploying? How are you acquiring users effectively that drives a really, really high and growing lifetime value of that customer? So I think that those are important metrics. In terms of your cash burn, that's a key metric. So how much cash are you burning a month? Where is that going to be in 12 months time? That is a really important metric. Retention is an important metric. A lot of people use, I guess, revenue within their sort of LTV to CAC. Sometimes it's more important to use gross profit, because again, you can grow revenue very easily by just discounting. But gross profit tells you really about the financial health with a bit more certainty. And yeah, I mean, in terms of metrics, it also depends on the business model, right? User acquisition is not going to be pertinent to a product in diagnostics for healthcare specifically. So it really depends on the business model from my perspective.
Awesome, fantastic. Cecilia, anything to add there?
Yeah, so I have like my three favorite and a fourth one. So the first one, as I mentioned, is retention. And on retention, I'm looking, for example, on enterprise SaaS, anything that's trending above 110, 120% net revenue retention, that's great. On like more the consumer social side, more towards 45%, 6 months retention. And there is this article, I'm probably gonna link it there, from Lenny Ratinsky, which is like my Bible for retention. And it's literally what I use to kind of benchmark every company. The second is growth. We're aiming to look at businesses that had like 3x plus growth year on year on top line, because it tells us that there is this big market pool and this and we are a bit of a later stage investors, so that's why. And the last one is the LTV CAC. We are looking for businesses that are performing on average over 3x. I think that's what's considered the kind of minimum optimal way on the D2C and the B2C side to have quite an organic, sustainable business going forward. So ideally, you want to have an LTV CAC ratio of 3 or above. In this case, the bigger the better. And on the B2B side, I tend to look at payback periods as well. And just to add a fun one extra metric that I love is the MAU to DAU, so the monthly active users and the the DAU to MAU, so the ratio between daily active users to monthly active users. I'm quite fascinated by anything that's like a social app. So I think the power of like a social app is how many of the users you can drive to kind of open and use your software on almost a daily basis. And yeah, I think those are my favorite metrics and what I tend to look at a lot.
Awesome, really useful. And thanks for giving kind of not just what they are, but some actual benchmarks that everyone can look at and go, hang on, are we achieving that? And what do we do to get to that? Because that's part of it. That's part of it. You kind of get all these metrics listed all the while. I need to know your LTV CAC ratio, but what's a good one? What does a good one look like to an investor? So it's great that you've shared that. Myrto, anything to add? Any others there that you like to look at?
Yeah, I think Cecilia and George covered it really well. We don't per se at Pretora Ventures, we don't necessarily have kind of like thresholds for different metrics. I think what we do when we receive financials from a company and kind of some of their metrics, I think we tend to try and build an overall picture of the company using all the different metrics. So we don't, at least today, don't really have kind of like hard thresholds for looking at these metrics. I think one that I would add to the ones that were previously listed is churn as well. So, make sure you have sensible churn numbers and rates in your model. And then also another thing, and it's not necessarily a metric, it's more of, how you're building your model kind of question. But I think, and kind of going back to how we build the whole picture, I think really try to make sure that in your financial projections, what we oftentimes see is that, a company might be saying that, we'll be growing at, this crazy rate. But then what we'll do is go and look at the costs and see if that actually makes sense. So if you're saying like, I'm going to be acquiring 100 to 200 customers per year, let's say, but you haven't really accounted for more salespeople or more account managers or more, kind of whatever kind of roles are required to sell and retain those customers, then we'll probably take you up on that. So you build a very comprehensive story of how you build up in your company, including revenue and costs.
That's a really important one. It's something I bring up a lot because I see it so often where staff growth stops at year 2 and then revenue just keeps going. And by the time you get to year 5, your kind of revenue per staff is something like 8 million per staff. And to put that into context, like Amazon is 400K for every member of staff they have. Netflix is 1 million. The average in business in the UK is 135K for every member of staff they have. So if you're pitching to an investor and your cost base on staff is like 8 million revenue for every member of staff, you can very quickly see that you've just not got enough staff budgeted in the business, which means the profit is way out, which means the return on investment that you're looking to get and the exit valuation and all of those things all just start to fall apart. So yeah, it's growing your costs as well as your revenue. It's easy to think excitedly about revenue and forget that running a business of hundreds of millions revenue is going to take a lot of staff to keep it ticking over. You're going to need loads of customer service people or whatever it may be, loads of sales and marketing people to kind of keep that growth going. So yeah, really, really important point. Awesome. So we've got a couple of minutes left. So I'm just going to end on a really quick question from Stephen Selthofer. And he just asked, what do you trust more when it comes to making a decision, your gut instincts or detailed analysis? So when you're making decisions, does it come from the gut or does it come from the detailed analysis? What would you say, Cecilia?
I'd say a mix of both. The first thing, I don't know if I call it gut instinct, but ultimately, if I'm investing in a company, it's a Series A, and we've got to work with them for the next 7, 8, 10 years. I need to like what they're doing, no matter how brilliant the metrics. If I don't feel any sort of, connection, or I don't buy into their vision, or it's just not something that really interests me, I'm just not going to do it. And I don't think investors are honest about that enough. I'm quite lucky that at Talis I get to kind of work with whatever thesis I like and I personally enjoy. The other thing, there's 2 sides of the story. When you're evaluating a founder, there's a lot around like gut instinct, because we don't have net metrics for people. We can look at past successes, but that's not a predeterminant of future success. So I'd say it's a mix of both, but there is a good amount of non-metrics and just personal liking and getting along with each other.
So it's kind of the rapport with the founder and being able to buy into the vision before you do anything.
Exactly, and
you've got to have that in place as an absolute fundamental.
Exactly. If you come to me and pitch a digital health business, I'm sorry, I just don't like it.
Awesome. George, is that the same for you, or do you have a different take?
No, I agree with that wholeheartedly. It's a blend of the two. There's that intangible aspect of trusting your gut. I think your gut instinct over time develops for a reason, and it's based on your experiences, and your experiences should be insightful to you. So you should be able to develop a lens over time that says this is the right thing to do versus this is the wrong thing to do. And then the data and the numbers and the metrics overlays with that to build a full picture. So I guess there's a phrase, you've got the data and then you've got the eye test, so to speak, and it's very important to use both in harmony. It comes back to another point I made earlier about, someone might be really excellent operator, but do you get a sense that people actually want to work for this individual? Do they have a difficult personality? That's likely to come up at some point in the future, because again, what Cecilia referenced there, if you're taking VC funding, it's a long-term partnership. and so everything will come out in the wash. And I think it's really important to use both gut and data and metrics.
Fantastic, and I guess you would agree, Myrto.
Yeah, exactly. I would definitely agree. You kind of need a bit of both, and the thing I want to say is that it's the same exact thing for the founders. So, you know, just remember there's like so much capital going around that you too deserve to have the investor that's backing you, that's interested in what you're doing and believes in your vision. And not everyone is going to do that. And it's only normal because we all have different interests and passions in our lives. So you also want an investor who's going to be really passionate about what you're doing. And then just kind of going back to the gut feel as well, I think one of our values at Pretora Ventures is to do the right thing. And you can't really hard to define what the right thing is. But I think it kind of taps into the gut feel of, you know, you also want to invest in something that is right for the future and is right for society and is right for mankind, kind of. So I would definitely say that kind of plays into that gut feel as well. So make sure you're doing the right thing when you're doing business.
Fantastic. Also, what a positive way to end. So thank you to our panel, Cecilia, George, Myrto. Really insightful, and I think based on the comments, I think people got a lot from the three of you today. So thank you so much for coming here. I can't thank you enough, and sharing your insights with our community. So a few of you are asking where you can get the recording for this. This will be posted to our Robot Mascot YouTube channel. I'll probably post it out on LinkedIn as well. So if you connect with me on LinkedIn, and it'll also, I'll share a link in our Facebook group, Investable Entrepreneur. So they're the three places you'll be able to access the recording. And yeah, just to say that join us in a month, or I think it's about 6 weeks time. We've got David B. Horn joining us for the Fight for Fairer Funding, and he's going to talk all about the uneven playing field, which promises to be a really insightful session that I'm sure a lot of you will get a lot of value from. So thank you ever so much for joining me today, and thank you again to our panel, and I'll see you all soon. Cheers, bye.
Bye, thank you.
Thanks everyone.